Hello, and welcome to the Freddie Mac Connect Getting to Accept. Don't miss a home ownership opportunity session. All lines are in listen-only mode. This session is being recorded and will be available following the session. If you have any questions, please use the Q&A icon at the bottom of your screen. If you have any technical issues, please use the Q&A box as well, and someone will assist you. Lastly, using the handouts icon, you can find links to speaker bios in the presentation deck. With that, I will turn it over to Jim Clement, Senior Manager, Client Strategy and Optimization with Freddie Mac. Jim, the floor is yours.
Thanks, Amani. Welcome, everyone. Today, we're going to talk about ways that you can leverage Loan Product Advisor information, guide requirements or guidelines, as well as other opportunities to access credit to help work through scenarios that are initially receiving a caution to increase their likelihood of getting an accept. So the topics we'll cover today we'll focus a little on affordable loan eligibility, how to leverage affordable loan products such as Home Possible and HFA Advantage to overcome potential DTI challenges, as well as put yourself in a more favorable competitive situation to earn that borrower's business. We'll look at ways we can strengthen loan quality. We'll also talk a little bit about expanding access to credit through our rent payment and cash flow assessment opportunities, and then our last resort options. So let's get started. Affordable loan eligibility. Home Possible. Home Possible is a fantastic product that offers your borrower competitive pricing as well as reduced MI at your higher LTVs. So if you have a loan that you've submitted as a standard conventional mortgage and you're receiving a caution, and DTI could potentially be one of those factors contributing to that caution, Home Possible could be a great opportunity. We have a banner message at the top of the feedback certificate that would indicate the loan is potentially eligible for Home Possible and that you would need to resubmit to assess the loan as a Home Possible mortgage. You'll see it there, and that's our version 5.3 assessment summary banner at the very top of our feedback certificate. So if you see that message, that is an indication the Loan Product Advisor has identified the loan meets Home Possible income eligibility criteria and to resubmit to have it assessed as a Home Possible. Home Possible loans require the borrower's qualifying income to be less than or equal to 80% of the area median income. As you'll see in the top bullet there, Home Possible mortgages have zero credit fees in price. So as a result, they could be more advantageously priced than a standard conventional mortgage, therefore lowering your monthly payment and then having a positive impact on your debt to income. For loans with minimal or low down payment, such as 3% or 5% down, Home Possible also offers reduced mortgage insurance coverage. So a standard conventional mortgage at those loan to values requires 35% mortgage insurance coverage, whereas a Home Possible loan only requires 25% coverage, therefore lowering the monthly payment, and then also could have a positive impact on your overall debt to income. It also could help you if you're in a competitive situation with another lender, as leveraging Home Possible for the two reasons I just mentioned. Number one, zero credit fees in price, with the exception of custom MI, which would be included, and the reduced MI coverage could put yourself in a more favorable competitive situation. Matching your borrower with the most competitive and affordable product in today's environment would really help earn the borrower's trust and therefore put you in position to capture the deal. Next, we'll talk a little bit about HFA Advantage. So for those of you who are working or participating lenders with an HFA or a housing finance agency, HFA Advantage is a fantastic product. It offers many of the same benefits as Home Possible, such as zero credit fees in price. It also offers reduced mortgage insurance for borrowers who have less than or equal to 80% area median income at 18% coverage versus 35% on a standard loan, as well as 25% on Home Possible. It also provides the borrower with the opportunity to leverage down payment assistance. So if a borrower comes to you, they are short on funds or have limited assets for cash to close to complete the transaction, working with the housing finance agency, leveraging that down payment assistance could be what the borrower needs to overcome that obstacle and then thus get approved for the loan. It also could help from a debt to income perspective if that is an issue with the reduced credit fees and price for all borrowers in HFA Advantage loans, as well as the reduced MI coverage for those that have less than or equal to 80% of the area median income. If you submit a loan or intend to submit a loan to Loan Product Advisor as an HFA Advantage, you must select the appropriate HFA Advantage loan program identifier, and you can check and ensure that you submitted it accurately by looking at the feedback certificate and seeing your offering identifier listed as HFA Advantage. It's a great product, especially for those lenders who are working and participating with housing finance agencies, to give that borrower the option and flexibility to leverage down payment assistance funds to complete your transaction, as well as reduced MI coverage for those eligible, and take advantage of our zero credit fees and price. We have a couple other affordable loan options and opportunities to provide the borrower with the most advantageous pricing available to them, which they're eligible for. We have messaging in LPA that fires on every loan, and it's this message FAL0011. It provides you with the area median income for the subject property address you've submitted, as well as the calculated AMI percentage based on your qualifying income submitted to LPA. So you'll know exactly where the borrower stands in relation to the AMI level for that particular property. You can leverage that message to see if your borrower is eligible for one of our other credit fee and price caps. So we have borrowers who are less than or equal to 100% area median income, and that are first-time home buyers are eligible for the caps. If you're a first-time home buyer and you're less than 120% in a high-cost area, you're also eligible, as well as several of our other duty-to-serve products, such as Green Choice, our Choice Renovation product suite, Community Land Trusts, Manufactured Homes, and our Choice Home. In addition, homes located in a rural area and high-needs rural areas are also eligible, all assuming the borrower's income is less than or equal to 100% of the area median income. We've added a series of messages throughout the course of the year to help lenders like yourselves identify these opportunities more easily. And the one message that you want to look for is FAL0045, which indicates this loan may meet certain eligibility criteria as outlined in Guide Exhibit 19A, Credit Fee Cap Eligibility Criteria. That means you have triggered one of these indicators, and one or more of those indicators, I should say, and your loan is going to be eligible for those credit fees and price. And the reason why I bring this up is that your borrower is eligible for them. You want to make sure that you use them and ensure that your borrower is receiving, the best, most competitive and affordable product that's available to them based on their eligibility. Now we'll talk a little bit about ways to strengthen loan quality. First, look at your borrower liability payments. So we have a couple guide requirements that are very advantageous for borrowers that have student loans. So if you have a borrower that has student loans reported on their credit report with a balance and 0 monthly payment listed, our requirement is to use 0.5% of the balance as the monthly payment. Ensuring that is entered accurately will make sure that the loan is assessed properly, and you will not have any erroneous data being submitted to LPA that could potentially impact your risk assessment. We also recently implemented income-driven repayment plans that would allow the borrower to use that payment amount if, for one reason or another, that payment is less than the 0.5% of the balance, assuming there's no monthly payment listed on the credit report. Accurate information submitted to LPA is always going to yield the best results. Alimony. So if you have a borrower that is paying alimony, our requirement is to deduct that amount from the monthly income versus adding it in as a debt. Some loan origination systems will automatically do this, others will not. So it's important to understand that is our requirement, number one. And number two, enter it in accurately, as deducting it from a monthly from the income will have a much more favorable impact to the debt to income versus adding it as a monthly debt. Cosign debt. If the borrower has any cosign debt on their credit report, it's important to talk to them about it. Find out the details around it and see if they meet the eligibility requirements to have it removed from the DTI. Are they making the payments, or is the cosigner making the payments? Do they have the appropriate history of doing so, and can they document it? This could be the difference between a DTI falling within guidelines or outside. Look at the credit report. Review it with the borrower. Make sure there's no erroneous items being listed or included in the monthly liabilities that could have an impact or an adverse impact on the debt to income, as well as disputed trade lines. So if you have more than 2 disputed trade lines, LPA may not give a risk assessment on that loan. So talk to the borrower about those disputed trade lines. Ensure that everything is being reported accurately. They could be years old and have been already resolved, but yet not updated accurately on the credit report. So that's something to have a conversation with the borrower about. Make sure everything is accurate. Everything that's going into LPA is 100% true. And that way it will have the best impact on your risk assessment. Assets and reserves. Reserves are probably the number one compensating factor a borrower can have to offset some of the layers of risk that go into a risk assessment in Loan Product Advisor. We fire a message that indicates reserves could help strengthen loan quality if the loan does receive a caution. So it's important to look for that. But my recommendation is, on every submission to LPA, talk to your borrower about the amount of assets they have. Ask them what types of accounts they have. List them all in your loan origination system so that they are accurately passed through into Loan Product Advisor and included in the risk assessment. I recommend doing this on the very first call. Make sure all of your submissions include it. I have yet to look at a loan where reserves have negatively impacted the risk assessment. It can only help. And like I said, it is probably one of the main compensating factors a borrower can have to offset some of those layers of risk that go into our risk assessments. So I spoke a little bit about housing finance agencies and their ability to offer down payment assistance to borrowers. So I wanted to touch on our affordable seconds and how they are entered into Loan Product Advisor accurately to ensure that they are assessed properly. So there are 2 types of affordable seconds. One is an amortizing affordable second, which means it requires a monthly payment either at the onset of your new mortgage or within the first 5 years. And then the other is a non-amortizing affordable second, which does not require a payment for at least the first 5 years or 60 months. So it could be a forgivable second. It could be forgiven over 3 years, 5 years, or 7. As long as there are no payments required for at least the first 5 years, it would be considered a non-amortizing affordable second. So I have a screenshot here of our LPA on the web just to illustrate some questions that you'll need to answer to ensure that these are reflected accurately in your submission. So these questions should be in your loan origination system. They may look a little bit different, but the wording should be similar, and the answers are definitely going to be the same. So is your other new mortgage an affordable second? That would be yes. And then is your affordable second payment deferred? So if you are receiving an amortizing affordable second, the answer there would be no, and you would be required to put in a monthly payment. However, the example you see here is our non-amortizing affordable second. So is the other new mortgage affordable second would be yes, which is always yes. And then is the other affordable second payment deferred, which would also be yes for that non-amortizing affordable second. And then as a result, your monthly payment would be required to be submitted as 0. So don't leave it blank or null. It has to reflect 0. And the reason why I stress this is each one of those 2 affordable seconds is assessed a little bit differently in LPA. So an amortizing affordable second, so one where a payment is required at the onset, is has a little more impact to the overall risk assessment. It adds a little bit more of a layer of risk to that risk assessment, whereas a non-amortizing affordable second is a little more favorable from an overall risk perspective. So both of them are perfectly fine and okay to receive, but it's important that they're entered in accurately based on the type the borrower is receiving to get an accurate assessment from LPA. The borrower is also eligible to receive gifts or grants from eligible sources. So gift funds are very popular. A related person can give the borrower a gift, enter it in as an asset, and submit to LPA. It can be used towards down payment, closing costs, and potentially reserves based on the other assets they have listed on the loan. So make sure you're having a conversation with your borrower about all the different types of assets they can use and leverage to complete the mortgage transaction, as it could definitely help in your overall risk assessment and potentially create a more favorable scenario for your borrower. Expanding access to credit. So let's look at this scenario. So if you get a feedback message associated with a caution because the borrower may not have enough credit history, check your LPA feedback messages in the credit and liabilities section to see if your borrower is potentially eligible to utilize our rent payment or cash flow opportunity. So when you submit a loan to LPA, and if you get a caution, like I said, check the credit and liabilities message section and look for message FCL 0421. We have two offerings. One is a rent payment history and the other is cash flow. So if your borrower is a first-time home buyer, they're listed as renting on their application for at least $300 a month. Those are the initial criteria for eligibility of our rent payment history. So if LPA determines that a positive rent payment history could benefit the borrower and maybe give them that little bump they need to get from a caution to accept, it will fire that message. If the borrower doesn't rent or they're not a first-time home buyer or they meet other eligibility criteria, you could see the message that displays cash flow could be could have a positive impact on the overall risk assessment. So that message, the code is the same. The verbiage is dynamic based on the eligibility LPA determines. So if you see that message, that's an opportunity to talk to your borrower about obtaining an asset report from one of the Freddie Mac approved third-party providers, and make sure that the borrower, they rent or pay their rent every month from the same account. The amount that they pay is consistent. Make sure it makes sense, that they're going to be able to see that history on that asset report so LPA can accurately assess it. Also, if you're looking at cash flow, make sure you include or link all of the borrower's accounts where they have money deposited, because cash flow assessment is going to look at the transactional history for that borrower to see that they are managing their money effectively and have basically more money going in than they have going out on a monthly basis. So if you order an asset report, submit that loan to LPA, you will then get a message. Hopefully you will see the loan turn from a caution to an accept. And if it was successful, you'll see one of these two messages. So if you're using the rent payment history, you will see FCL 0417, which indicates that that loan was successfully submitted with an asset report, rent payment was successfully identified, and your loan is now an accept. If you're utilizing cash flow, it's FCL 0426, and it indicates the same, that LPA reviewed the asset report and identified a positive cash flow, and your loan is now an accept, which is a pretty positive and powerful thing to communicate to your borrower. And you're not having to restructure the loan. You're able to offer the same terms, and you've just by adding an asset report to that submission, you're now able to get that loan approved for your borrower and potentially allow them to move forward with purchasing a home. There are other things that you can also leverage or other services that we offer through that same asset report. You could have all of the assets that are required for closing verified. So, the documentation will be very streamlined from there on out. We also offer the opportunity to verify income through our direct deposit offering, again, using that same asset report. So what a cool scenario it would be if you received the caution, had the conversation with the borrower, linked an asset report, submit it to LPA, you get the loan approved, and not only do you get the loan approved, but you're also able to communicate that you've streamlined the verification of both their assets and income through our same offering. So what a great way, to earn the borrower's trust, get them approved, and hopefully put yourself in position to win that customer's business when they do find a house. The last resort. So if none of the items that we've previously discussed has had a positive impact on getting that loan from a caution to an accept, we would go down the traditional path of lowering your loan to value, putting a little bit more money down, maybe lowering the sales price, talk to the borrower about getting a cosigner, all of your traditional options that, you would potentially go through. But what we want to stress here is that we have some opportunity, or we believe we have some opportunities to potentially get that loan approved without having to go down this route, providing the borrower with an approval in and around the terms that they had originally requested, which is probably that price range that they need to be in to buy a house in the area they're looking at. So hopefully you can take advantage of some of these items that we've talked about today. None of them should be probably mind-blowing, probably really good reminders and things that, as you work through your loans, maybe it's struck a chord and you say, oh yeah, I forgot about that. Hopefully you can utilize it. And again, LPAs, not necessarily, or a caution in LPA is not necessarily a rejection. It's just a redirection to uncover missed opportunities. They're there. Let the technology work for you. We've seen a lot of recent success with the cash flow offering in getting loans approved at a really good rate. So I highly recommend, if you're not using it, look into it. It could really make the difference between getting that loan approved and then taking advantage of every opportunity and every borrower that you come across. So I just want to thank everyone, for attending today's session. Hopefully you can leverage this, get that one loan approved, maybe get that one sale, and that would be awesome. So Imani, with that, I will turn it back to you.
Thank you, Jim. Unfortunately, we were not able to get to your questions today. However, we will reach out to you following the conference. Your opinion is important. Please take a few moments to take our brief survey so that we can continue to bring you timely and relevant content. The presentation deck will be sent to you following the session. You can also log in anytime after the conference to play back this or any other session. Thank you and enjoy the rest of the conference.